In today's episode, I'll talk about two stories. In the first one, I'll talk about how Yes Bank went from a near collapse a few years back to now landing a billion-dollar partner in Japan's SMBC. And in the second story of the day, I'll talk about how Titan and Kalyan Jewellers are navigating rising gold prices, shifting consumer preferences, and a fast-changing jewelry market in India, and what their latest quarterly results talk about their strategy. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 13th of May. See, one of the biggest Japanese banks in the world is about to buy a big chunk of an Indian private bank. And it's not just any bank, I'm talking about Yes Bank. According to reports, Sumitomo Mitsui Banking Corporation or SMBC is planning to acquire a 20% stake in Yes Bank for around 13,483 crore rupees. That, mind you, is $1.6 billion. Now that number alone is quite big, but the reason why the story matters goes well beyond the size of the check. It's actually about what this entire deal means for Yes Bank and also for SMBC and also for India's entire banking landscape. And the reason why this is crazy is because foreign banks are very rarely allowed to own such large stakes in Indian private banks. The Reserve Bank of India is usually very cautious when it comes to outsiders taking control of domestic lenders. So when something like this happens, it is worth pausing and asking, why now? And to understand exactly that, let's rewind a little bit, because Yes Bank story is not just a banking story, it's actually a lot of a roller coaster about ambition, failure, rescue, and now maybe also redemption. Let's start from the top. See, in the early 2010s, Yes Bank was the rising star of Indian banking in many ways. It was aggressive, it was modern, and it also wanted to be India's next HDFC bank. Its founder and CEO Rana Kapoor had built a brand that investors absolutely loved. The bank's loan book was growing rapidly, and every year it was lending more money, expanding its presence, and also chasing growth like there was absolutely no tomorrow. But that chase came at a cost. In 2015, UBS, which is one of the world's most respected financial institutions, flagged something concerning in a research report. They said that Yes Bank was heavily exposed to corporate borrowers that were already struggling. In other words, Yes Bank was taking on more risk than it would handle by giving loans to companies that other and more conservative banks were staying away from. And UBS was not wrong. Over time, Yes Bank had become a key lender to a list of companies that would later go on to collapse. DHFL, the Reliance ADAG Group, SL Group, Vodafone Idea, Jet Airways, and several others. Now, this was like a ticking time bomb in many ways. And when those companies started defaulting on their loans, Yes Bank's troubles obviously started to begin. But instead of confronting the problem, Yes Bank actually tried to cover it up. They underreported their bad loans and also their non-performing assets or NPAs. On paper, in FY 2019, Yes Bank claimed its NPAs were just over 3,200 crore rupees. But the RBI was not at all convinced with this argument. They ran an asset quality review and they discovered that the real number was many times higher than that. Eventually, estimates showed that the bank's bad loans may have reached well over 50,000 crore rupees by late 2019. And that was not just a case of bad luck. It pointed to deeper governance issues, and the spotlight very quickly turned to Rana Kapoor, who by this time had become a very controversial figure. Investigations suggested that he had taken kickbacks to the tune of 600 crore rupees in exchange for giving loans to some of these troubled companies. Rana Kapoor stepped down in 2019 and he ended up selling most of his stake in the bank, but the damage had already been done. Yes Bank was in a free fall of sorts. Its capital was eroding, investor confidence had almost vanished, and even worse, its depositors were getting very anxious. Yes Bank was basically in a real risk of a bank run, which is when people start pulling out money in panic, which can very quickly destabilize not just the bank, but the entire financial system. Now, the RBI had no other choice, so in March 2020, they stepped in with a rescue plan. First, they imposed a withdrawal limit of 50,000 rupees per depositor in order to prevent a full-blown run. They asked State Bank of India, along with a group of other major banks like ICICI and HDFC, to pump in some fresh capital. And together, they infused about 10,000 crore rupees. In return, they got a sizable chunk of equity in Yes Bank. But that said, this came with a very strong condition. There was a lock-in period during which they were not allowed to sell their stake in Yes Bank. And this was basically the beginning of a very new phase for Yes Bank, which was a recovery phase. See, with Rana Kapoor out, the bank now got a new CEO in Prashant Kumar, who was an SBI veteran. And under his leadership, Yes Bank slowly began cleaning up all the mess that it had created. One of the biggest steps was selling nearly 48,000 crore rupees worth of bad loans to JC Flowers Asset Reconstruction Company, and that gave the bank a much cleaner balance sheet overall. It also managed to recover over 5,000 crore rupees in earlier bad loans. And bit by bit, basically, they reduced their exposure to risky corporate borrowers and also shifted focus towards retail and SME loans. And fast forward to March 2025, nearly 60% of its loan book has been made up of retail and MSME lending, which is a big jump from 36% just 5 years ago. Now, this of course attracted new investors. Global private equity firms invested fresh capital into the bank, which helped it strengthen its financial position. And slowly, confidence started coming back into the bank. The bank returned to profitability, its capital adequacy improved, but the one thing that did not return is investor euphoria. See, the market still very well remembers how badly things had gone in the first time. In 2023, the lock-in period for those initial rescuers, which is SBI, ICICI, etc., finally expired. Now, they officially could sell their stakes, but instead of rushing to exit, they actually ended up waiting. And they were possibly hoping for a better deal at that time. And now, with SMBC's offer on the table, it looks like that particular bet has paid off for them. But all said and done, the question really is, why is SMBC even interested, and why is a Japanese bank putting so much money into an Indian private bank? See, to answer that, let's understand SMBC's strategy first. See, SMB is a part of one of Japan's largest financial institutions. For years, they have been quietly building a presence across Asia. But instead of launching new banks from scratch, they have been buying into existing players. In 2021, they acquired a majority stake in Fullerton India, which is a non-banking financial company known for its retail lending. And by 2024, it had been rebranded to SMFG India Credit and was fully owned by them. But that still did not give SMBC a proper bank in India, and that is where Yes Bank fits in. It has a wide branch network, a full banking license, and a large customer base. And now it's no longer a distressed asset as well. The turnaround has basically been done, which means SMBC is buying into a relatively stable platform with a lot of room for growth. Now, of course, getting a 20% stake in an Indian private bank is not at all easy, like I mentioned. RBI rules normally cap foreign ownership and banks at about 15%. But that said, there have been exceptions being made in the past, most notably in 2020 when Singapore's DBS Bank was allowed to take over Lakshmi Vilas Bank, which was in trouble at that time. In Yes Bank's case, it looks like the RBI is comfortable enough with its current health in order to allow a high stake from a foreign strategic investor. It's a sign of trust both in Yes Bank's recovery and in SMBC's credibility. So that said, the question then is, what does all of this mean for Yes Bank? See, this deal is a bit of a game changer for them. It brings in a long-term, globally respected partner for them. Until now, Yes Bank was majorly owned by Indian banks that were, in a sense, babysitting it through this entire crisis. Now, that structure was never meant to be permanent. SMBC's entry basically now marks an entire new chapter in this game. It's a sign that the recovery phase is officially over and the bank is ready to move forward from here. SMBC will likely take up board seats in the company and will also participate in governance, which means that Yes Bank stands to benefit from international best practices, especially in areas like risk management, compliance, and operational discipline. Now, for SBI and the other rescuers, this is also a very graceful exit. They stepped in when the bank was on life support of sorts, they helped it bring it back to health, and now they get to cash out, and at a time when valuations are improving and public perception and sentiment is a lot more stable. Now, whether all of this ends up leading to a blockbuster growth for Yes Bank or not remains to be seen, but one thing is very clear: Yes Bank is a story which once looked like a cautionary tale and is now starting to look like a case study in revival, and that itself is no small feat. On that note, let's move on to the second story of the day. India's jewelry industry has always been very big, emotional, and also very deeply personal to a lot of people. Families basically pass down ornaments through generations, and gold in India at least is seen as a sign of wealth, safety, and also a lot of tradition. And for many decades, this particular market has mostly been dominated by small family-run stores across every town and city. Now, these are jewelers that people usually trust because they and their ancestors have known them for many years now. But that, ladies and gentlemen, is slowly starting to change now. See, over the past few years, India's jewelry market, which is by the way worth nearly 5.5 lakh crore rupees, has been going through a very quiet but a very powerful shift. The share of organized players in the industry has grown quite fast from around 23% in 2019 to around 37% in 2024. Now, that is a massive leap for a market that used to almost entirely be unorganized. And it means that more people are now walking into branded showrooms instead of local jewelry shops. And this also means large players are getting bigger and a lot faster now. now. Now, this change is being driven by a mix of factors. Regulations have gotten tighter, buyers are becoming more quality conscious and also digitally savvy, and companies that offer standardized pricing, purity guarantees, and consistent experiences are winning the trust. Now, in this new industry setup, two particular companies are standing out quite prominently: Titan Company and Kalyan Jewellers, and both of them are now seeing sharp double-digit growths year over year. Now, both of them are opening hundreds of stores, and both just reported very strong results for the March 2024 quarter. Let me start with Titan. See, despite high gold prices and an overall uncertain business environment across the world, Titan has had a very solid quarter. Their total revenue grew over 21% compared to the same period last year, and the company's jewelry business, which by the way makes up to over 85% of its total revenue, grew even faster at about 23.7%. And what's interesting is that this was not just from adding new stores. Sales from Titan's existing stores also went up by 15%, which means that more people are buying more jewelry from the brand that they already know. But the quarter also had a lot of challenges. Gold prices, like I said, shot up sharply by around 30 to 40%, and that put a lot of pressure on margins. Now, high gold prices usually eat into profitability because it becomes a lot more harder to pass on the full cost to consumers. But Titan managed this very carefully. They cut costs in other parts of the business, and they used hedging strategies to reduce the impact of gold price volatility. And the result was that the company's jewelry margins fell only very slightly, which is by 0.25 percentage points. But that said, not every single part of Titan's jewelry business did equally well here. One of the very important segments, which is studded jewelry, which by the way includes pieces with diamonds and gemstones, did not really grow as strongly. In fact, its share in the overall product mix actually dropped by 3%. Now, some of that actually has to do with changing consumer preferences around diamonds, which is a point that I will come to shortly. Anyway, Titan's performance beyond jewelry was also mixed. The watches division had a strong quarter with nearly 20% growth. Fast Track, which is one of its youth-focused brands, also saw about a 44% jump in sales. Its premium watches, which is sold through Helios, also did fairly well. Even the eye care business grew at about 16%. But the company's newer verticals like fragrances and ethnic wear are still sort of struggling to find their footing in the market. Now, these businesses saw falling revenues and also rising losses this particular quarter. But all said and done, overall, Titan stayed fairly disciplined. It did not really overreact to the chaos in the gold markets, and it managed its operations fairly efficiently and also continued to expand in a very measured manner. And if and when gold prices do stabilize in the future, Titan is very well placed to further benefit from it. Anyway, let's move on now to Kalyan Jewellers. Now, they had a very different approach here and also a very strong quarter. Now, its revenue went up by 37% year over year, with the bulk of that actually coming from its Indian jewelry business. Now, wedding season demand was fairly strong this time around, and just like Titan, a lot of the growth came from stores that were already open by the company. Same store sales went up 21%, which is a very, very healthy number, especially in this particular industry. But that said, rising gold prices did affect Kalyan's margins as well. And there was another reason for this pressure, which is the company has been moving more of its businesses to a franchise model. Now, in a franchise setup, for your context, profits per store tend to be lower for the brand, even if the overall sales tend to go up. And as a result, the EBITDA margin of Kalyan's India business dipped slightly from 6.6% this quarter last year to 6.4% in this particular quarter. But the company still remained fairly profitable because its net profit grew 36% year over year. Now, interestingly, unlike Titan, Kalyan's studded jewelry segment actually did really well this time around. Sales in this particular category jumped 47%, which increased its share in the product mix to 31%, up 2% from the same time last year. Now, this shows that customer preferences are not moving in one direction across the board, and also that different players are now finding different ways to adapt to this particular thing. Kalyan also has a growing international business, like you may have figured. Its operations in the Middle East have posted a 26% revenue increase this particular quarter with very stable margins. But that said, on the digital part, things were slightly slower. Candor, which is Kalyan's online first jewelry brand, had a fairly muted quarter. And in response, the company now plans to open 80 new physical Candor stores this particular year. Now, that, mind you, is a big shift in their strategy, which basically turns an online first brand into an offline one. And it also shows that the company is willing to experiment in order to find the right model. Also, both Kalyan and Titan are now planning major expansions. Titan is being relatively careful. It wants to open 40 to 50 new Tanishq stores in the next year and expand or renovate 50 to 60 more stores. More of this growth is coming from smaller towns and cities, which is places beyond tier 1 parts of India. Titan is also trying out a new kind of store model, which is franchise owned but company operated model, which is also called FOCO. Now, this means that the store assets belong to the franchise, but Titan will directly manage the day-to-day operations. The company says that this is in order to avoid succession issues and to also ensure smoother operations as the business becomes more and more complex as time progresses. Now, what's interesting here is that this FOCO model was actually inspired by Kalyan's playbook itself. But talking about Kalyan, they are scaling far more aggressively. They want to open 170 new stores this year, which is almost 4 times Titan's expansion plans. 90 of these stores will actually be under the Kalyan brand, and about 80 will be under Candor's brand. Kalyan is also rapidly moving beyond its South Indian stronghold. In fact, more than half of its revenue now comes from outside the south part of India. And most of these new stores will be franchise-led, which basically helps the company grow faster without really spending heavily on buying property or taking on too much debt. And by 2027, they are expecting about 55% of their India revenue to come from franchise stores, which is up from around 40% currently. Anyway, all that said and done, one thing that was a big topic of discussion this quarter was obviously gold. See, gold prices have been rising globally since the beginning of this year. With global uncertainty rising from geopolitical tensions to currency shifts in many countries, many investors have now turned to gold as a safe haven. Now, this increase in demand has basically made gold a lot more expensive. And for jewelers, this has created some very unusual effects. At Titan, the company noticed that when gold prices crossed some key levels, the demand for entry-level jewelry started to drop quite significantly. First-time buyers and budget-conscious consumers simply stopped shopping altogether. And in order to adapt to this particular change, Titan started introducing lighter designs and jewelry that is made with lower purity gold, like let's say 18 karat or even 9 karat gold, in order to bring down the price points. And for high-value buyers, it simplified designs so that they could get the same weight of gold with lower making charges. And all of this basically helped Titan protect its margins at scale. Titan is also now rethinking about how it finances gold purchases. It's considering increasing its use of gold on lease, where instead of buying gold upfront, it can lease it for a fee. And this basically keeps working capital free for them. But that said, even this has become more expensive lately because the lease rates have gone up because of the gold prices. And if we talk about Kalyan over here, they also felt a bit of heat here. They use gold metal loans, which is a fairly similar idea to gold on lease, in order to manage their inventory. But this quarter, GML interest rates spiked from 3.5% to 5%. And on top of that also, there was a temporary disruption in the GML market, which forced Kalyan to tweak its financial plans in the middle of the quarter itself. It had intended to reduce regular debt, but they instead had to cut down on GML exposure because of the volatility. But all said and done, rising gold prices have also helped Kalyan in a very unexpected way. See, because plain gold jewelry had become so expensive, customers were suddenly more open to spending a little bit extra and switching to studded jewelry. Psychologically speaking, the difference in price did not feel very large anymore, and that is partly why studded jewelry segments did so well. Another important topic that came up this quarter was lab-grown diamonds, which I also touched upon when I began this story. See, Titan addressed this in its analyst calls. Right now, Titan is staying away from this category altogether. They basically feel that the economics are not yet stable. Prices of lab-grown diamonds have been falling very fast, from up to 50 to 60,000 per carat last year to as much as 30,000 rupees today. And even at these prices, many new players are now entering the market, which suggests that more price cuts are lying ahead of us. Now, Titan basically does not want to get in a race to the bottom. They said that the risk to Titan for this is not huge, at least not as of yet. As per them, lab-grown diamonds are mostly eating into the solitaire market, but over 95% of Titan's studded jewelry revenue comes from small natural diamonds and not big solitaires at all. And that particular segment for them has remained fairly stable and even grown over time. So basically, Titan's call to wait over here makes a fair bit of sense now. Also, by the way, this particular insight, which is about Titan's stance on lab-grown diamonds, was not easily visible everywhere. It was actually hidden in the company's analyst calls. But that's exactly why reading these calls can be so very valuable. There are plenty of nuggets that can rarely make it to the headlines. And to get into the depths of exactly that, we have recently started a new newsletter called The Chatter. Our idea here is to get into the depths of what the management is saying about their company as well as the industry that they operate in. And through this newsletter, we hope to give you some insights that you and I may not have been able to uncover in our regular reading habits. Anyway, back to the story. In the end, all of this was sort of a revealing quarter for India's jewelry giants. Titan played it fairly safe because it defended margins, kept its operations tight, and also expanded very cautiously. Kalyan, on the other hand, went very big, where they chased growth aggressively, expanded its reach, and also surprised the market with its strength. Both had, of course, very different strategies, but both managed to hold their own during a volatile time. That brings me to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, ACME Solar Holdings Limited has commissioned 52.5 megawatts of solar capacity in Rajasthan's Bikaner district, which marks the first phase of its 300 megawatt ACME Sikar solar project. Spread across approximately 1,300 acres, this project will transmit power to the Bikaner 2 grid through a dedicated 220 kV transmission line. Second, PVR Inox reported a consolidated net loss of 125 crore rupees for Q4 of FY 2025, which is marginally lower than the 130 crore rupee loss in the same quarter last year. Revenue from operations came in at about 1,250 crore rupees, which is down 0.5% year over year and 27% sequentially from 1,717 crore rupees in Q3 of FY 2025. Third and the final one for the day, DCM Shriram Group's Fenestation business, Fenesta, has acquired a 53% equity stake in DNV Global for 44 crore rupees. This acquisition is expected to be completed within the next 2 months. According to a company statement, the strategic investment is aimed at enhancing product reliability, deepening vertical integration, and creating new business opportunities in the hardware segment. That's all the news and stories I have for you today. I hope you enjoyed this show. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.